Can the taco turnaround hold? Hi, everyone. Welcome to the Market House. I'm Maggie Lake, and today I'm talking markets with Katie Stockton, founder and managing partner at Fairlead Strategies and portfolio manager at the TACK ETF. Hey, Katie, how are you?
Hi,
Good to see you
Maggie. Good to be
again.
with you today. Yeah.
Hey to everyone who's joining us live on Substack and YouTube. As always, put your questions in the chat. We'll get to as many as we can. And I see we have a couple already, which probably gives us an indication of what kind of market this is. And Dee wins already with a great comment. Bear market over after one day. Too much money.
I know
Too much money sitting in money markets. That's a really interesting observation, and we'll talk about that a little bit. But I think we have to start with stocks, Katie, because we just spoke before we came on, and I left with a very bad feeling on Friday. I think many of us did, and we're really concerned about what was going to transpire when we opened today. And yet the market was up. What are sort of you looking at in terms of this rebound?
Yeah, I mean, it was a concerning move, but not just in terms of the magnitude of the move as much as it was the impact on the indicators, because it did have an impact on the indicators. And I can show you the chart in a second, but I'll say we're always waiting for confirmation. I'm sure some of your viewers know us well on that front, because we're never quick to jump on a one-day move, never ever, because there's risk to that, because there's whipsaws both directions, and some days you just get these headlines or something emotionally charged and it ends up being noise. And to navigate through that type of noise, we like to smooth things out and always wait for confirmation. So that's the mode in which we are in now this week. Even today, we're focusing on some key levels just to determine if this was a real, breakdown. It wasn't a breakdown below any key levels, but a real reversal, I guess, is more the accurate term, or something that we can just treat as noise, because indeed it's been an incredibly noisy market. I'll share my screen to show the S&P.
Yeah, while you do that, it's a noisy market, but it's also a noisy world we're living in, because, part of what people were grappling with as they were looking for the futures was that all of the news breaking from the Middle East, all those headlines were, churning as we were trying to figure out what's going on. So there's so much for investors to track right now.
Yeah, for sure. And we had simplified it, because what we found is the character of this market was really unique. This is the S&P 500. I hope you can see this. Can you see the screen? Okay, good. So on the daily chart, what we found, and you all know the MACD indicator, so you can see how noisy it's been. I mean, we've had buys and sells really throughout the uptrend off of the April low. So in June, when we had the breakout to new high, we said, you know what, the MACD is too noisy right now. We're going to focus on the 20-day moving average as our preferred trend following gauge, our best way to eliminate the noise of these 2-3 day pullbacks. So that's the blue line. You can see the blue line has been trending higher up until just the past 3 or 4 days. So the 20-day, when the 20-day rolls over, we found that to be a good time to maybe hedge partial exposure, reduce some exposure. We're not talking about, selling everything by any stretch, nothing dramatic. But if you want to manage risk through a pullback, it's probably a good time to do it, referencing historical turning points for the 20-day. And the 20-day for us eliminates the right amount of noise without, eliminating too much of it. So we feel that if it does roll over decisively, which it really hasn't quite done, so we're sort of more flat right now. When it rolls over decisively, that will be our cue. The other indicators that we track, not even the MACD here, but the intermediate term metrics that we track would suggest that indeed we will get that downturn. So we're kind of bracing for it. Here's one example. This is on the weekly chart of the S&P 500. You can see these are the DeMark indicators, for those that know them, floating above the price bars here. When you see a 13, that tends to be a turning point. And of course, we had a 13 that was subsequently confirmed on Friday with that downdraft. So one of the DeMark indicators had a sell signal. And at the same time, we had a downturn in the weekly stochastics. So these two indications taken together would suggest that we could see maybe several weeks of corrective action. As much as we don't want to see that, it certainly could happen. Based on these indicators. And it's a little misaligned with the seasonal influences that we're accustomed to. But I feel like, if we didn't get the volatility September and early October, well, perhaps it comes later October into November, and then we have a better finish to the year.
Yeah. Interesting, because I know I think you touched on this a moment ago, but Marcus saying actually surprised how daily MACD on a lot of individual stocks were not that impacted on Friday. Katie, could you comment?
That's interesting. I haven't done enough bottom-up work to, I guess, reflect on that with you necessarily. But what it probably means, I'm guessing you have a list of some pretty good uptrends, because what happens when you see these steep uptrends, the MACD will diverge quite a bit, and then you'll see maybe just a minor downtick. It's almost like it takes time to catch up with price, because it is a historical look back. It's an exponential moving average or a derivation of that. So it does take time for it to turn. MACDs and stochastics and RSIs, all of these will have a little lag to them when it comes to turning points. And that's okay with us, because we feel that it will discern an important reversal versus just noise. And you saw for when that downturn in the weekly stochastics, that's something that we feel is more than just noise, probably. So a downturn below 80% is one of our so-called like overbought sell signals. We don't mind an overbought reading. We actually like to see that. That means there's momentum. But when you see those crossovers to the downside, just like we're likely to see in the MACDs eventually, that is something of a setback.
And you guessed right. Marcus said heavily invested in batteries and rare earths. So yes, very strong uptrend. Good for you, Marcus.
Yes, exactly.
Is there a level? One of the things that was really, interesting to me on Friday was the speed, right? That came on, and it was sort of tied to Trump's one of his comments, but I didn't really buy that. I felt like there was things building, and then when it broke, it really broke quickly. What are you looking for? So it looks like you've got signs that we're in for some sort of correction. What kind of levels on the S&P before we move on, and we will to commodities and some of the other questions coming in, but what kind of level are you looking for support? Like, what would, if something was taken out, what would be significant for you on S&P?
Yeah, and we often watch the 50-day moving average as a gauge of initial support and a strong uptrend. So that could apply not just for the S&P, but for those rare earth mineral companies or metal companies. We feel that the 50 days unrealistic as a likely stopping point for this pullback based on what we're seeing in those indicators. It's right around 65.30 as of this morning. So very close by now after such a big downdraft on Friday. So our secondary support level that we're watching goes back to the breakout point to new highs from the summer months. And it's right around 61.30. So a pretty big drop, right? 400 points on the S&P would be pretty meaningful. It doesn't mean, though, just that there's support there, doesn't mean it acts as a magnet for price. We, rather than adhering to support as a place where we say that's where we're going to add exposure, we will watch the indicators to help us discern when there's a better entry point at hand. But the support can kind of give you a sense of what downside risk might be, and also where, if we do see meaningful downside, buyers might step in.
Yeah. Again, I always find this very valuable work that you do, because and we say this a lot, but it gives you another framework to operate off of. So clearly, Marcus was in a trend in an area of the market he liked, but it's so important to have some of that price action to help, give you something to refer back to, especially when things start moving really quickly. I noticed the VIX today stayed elevated, clearly off where it was, but it was a little elevated. Are you watching the VIX at all?
We are, and outside of the 20-day moving average, the VIX was our primary, or is our primary risk metric at this time. So we've been watching the VIX as it relates to cloud-based resistance. And if you can hopefully see this,
yep, we can.
This is our daily chart. And you can almost see like what looks like a basing phase. The green line is the 50-day moving average. So that's now looking like it's a support gauge. And you see on Friday, we did get a breakout above the cloud. So what we were waiting for today, this is what I alluded to with our levels that we use for confirmation, was a second closing print in the VIX above 18, which is the upper boundary of this cloud. So the VIX isn't like a traditional stock price or something like that, where it trends in the same fashion. So we do take some of these levels with a grain of salt, but this is the one that we've been watching for a long time. You see also it's sort of flirting with the 200-day moving average. That 200-day, it would be a more stringent sort of qualifier, and that's at 19.3, which it didn't close above today. So we have what looks like a short-term breakout, certainly got through the cloud. That's our primary metric. So what it leads us to think is that it's probably a good time to put on some of those hedges, right? So irrespective of the fact that we bounced today, it didn't prevent some of the damage that's been done. And if we were subsequently to see that 20-day rollover, that would enhance that. So that's sort of our mindset as we come into the trading this week, is that if we see more weight of the evidence for the pullback like this, we're more inclined to either pick up maybe some inverse exposure. You can use an options strategy for hedging purposes, or simply maybe pick up something that's lower beta. I talked to my advisor, and he's going to move out of some of the higher sort of flyers, the more aggressive growth into dividend growth. And that's just one way to maybe lower the beta of the portfolio through more volatility. So there's a lot of different ways to do it without impacting your portfolio in a real, meaningful way, but just to manage risk. And at a very minimum, it would tell us that we want to wait to add exposure, right? Because when we do get these corrective phases, irrespective of how deep it goes, most stocks tend to bottom right around the same day, and that goes across sectors even. So even the winning sectors throughout the corrective phase, the ones that perform better than the S&P, they still tend to go down, even though they go down less, and they tend to also bottom around the same time, unless we're talking about something real specific, like related to a commodity or something like that. But generally speaking, I feel like everything bottoms right around that same day.
Yeah, well, you can always see it on the charts, even though it doesn't feel like it at the time. Great question from George, or comment. The big question, I think, is the profit taking on weakness. Will it be redeployed? I think that's what you're talking about, Katie. Will it be redeployed into market Spartans that I believe you wanted to say haven't participated, such as construction, pharma, energy, retail, or at least are not, sort of out of, I think the point is rotating out of that Mag 7. Are there sectors that look sort of technically better than others to you? Because I know you do break things down on sectors in your work.
Yeah, for sure. There always are. We just have to differentiate whether we're talking about absolute performance or relative performance. Because when we look at the sector work, I can pull up a chart here that
and feel free to fine tune that, George, if I didn't represent that question right. Sometimes autocorrect kills us all.
Yeah, it's interesting because we spend a lot of time on the relative performance of the sectors. Here's actually a great view. You can see the S&P 500 sectors in a relative rotation graph with their price history all normalized to the S&P 500, which is in the crosshairs. Anything that is pointing up and to the right is outperforming or has gained relative momentum versus the S&P. And you see the emerging leaders are energy, utilities, healthcare, whereas the ones that are falling out of favor are the mega cap heavy sectors, so tech, communications, and consumer discretionary. So that would indeed, tell us that the relative performance should shift, at least temporarily. This is just a 12-week view, so it's not a super long-term view, but it would hold relevance for a few weeks at a minimum. And it would tell us that we have maybe some safety to find in these more beleaguered sectors of the market, the ones that previously underperformed. But it doesn't mean that they'll totally avoid any kind of corrective action. I think it's hard for, even the most oversold names to just shrug off if the correction really, gets ugly, to shrug that off. It's pretty unusual. So even a healthcare name, super conservative, pharma, large cap pharma, that type of thing, it should do better, but I don't think it would avoid a pullback necessarily. You can find spots of strength always, but it's harder to do that, obviously, when things are going down. And when things go down, the correlations go up on the downside. So it's tough.
Yeah. And so let's talk about an area of strength. And I think Jonas was just saying earlier, how do we even begin approaching precious metals here? So I want to get your take on some of the price action we've seen in gold and silver. Before we do that, though, I want to play a clip for everyone. So I sat down with Grant Williams. I think I flagged this to subscribers. Know this is coming. Sat down with Grant Williams for the latest macro sessions, and talked about sort of, his current outlook on the macro environment right now. And he's paying really close attention to gold. Those who follow Grant know he does, but he's watching more than just a price action. Let's have a listen.
Gold has been incredibly strong, and that began with the central bank purchases over the last couple of years, and that they've definitely fueled that fire. But a lot of that, I'm sure, is people saying, well, actually, I'm going to ease up on my bond positions. I'm going to ease up on my, and I want a safe haven, neutral reserve asset that's nobody's liability, and gold performs that function better than anything else and has done for thousands of years. So the fact that gold has gone from 2,000 to 4,000 in a very short space of time should be a massive warning shot to people. Yes, there's some speculative froth in there because it's crossing all these previously unthought of price target levels. There's a lot of speculative money that's been sucked into it. But beneath that, there's a real clear message being sent by gold. And the fact that silver's going now, it suggests that the rally is starting to pick up steam rather than petering out.
A lot to be concerned. It was a great conversation. We're going to be releasing that next week to subscribers. If you are not a subscriber to the Market House, go to Substack. The links are in the description. But this is really interesting, Katie, because as exciting as it is, and for people who are long gold, good for you, but it has a lot of people worried and worried about what happens to even gold if these warning signs come to roost. And we talked a lot about what Grant's looking at, some black swans he sees other people may not be seeing. But there's a lot to worry about. First of all, let's talk about the price action of gold, and then let's talk levels.
Yeah, let me pull this up here. Here we go. So this is the price of gold, and this is what we're talking about in terms of the just parabolic move that it's seen. So when anything goes parabolic like this, I think naturally it does become a source of worry. Obviously, there's a lot of people worried about the AI trade as well. But to me, that it just means there's momentum, and we want to respect the momentum above all. And instead of anticipating something that's damaging, when we see something that's damaging, we react to it. So it is a reactive way of positioning, but it's also a way to not miss these really explosive up moves. So when you look at gold on this monthly chart, you can see that it's maintained an overbought condition for more than a year, about a year and a half, in fact. And it's pretty rare. We really haven't done it in recent history. So maybe that's concerning, but where we'll be concerned is when it turns down, goes back below that 80% threshold, and or perhaps when we see this MACD histogram, which is still ticking up and looks really quite good, start to tick lower. So those would be warning flags for us. We also have no active DeMark sell signal that we're concerned about at the moment. We're just watching some weekly signals that would support consolidation like we are expecting also in the S&P 500, but nothing to damage that long-term uptrend. So I think we're going to try to take the long-term view here and respect any consolidation as something that would be healthy.
Does it look like, I mean, right now this thing shows, there's no sign of the momentum stalling is what I hear you saying. Is that right? Because I feel like if you just looked at the price action of the last few weeks, you'd say, wow, this has come a long way. This has come far. But given all the macroeconomic conditions around what's driving it, some people are saying it's hard to say where even the resistance is for this. Like, it's hard to say how high it can go in this environment.
There really is none, right? So new all-time highs, but also this is important. You see how the MACD histogram continues to tick up here. So it does show very strong momentum. And even though there are some active DeMark signals, generally speaking, we're recommending folks stay with their long positions. Maybe they're not adding at current levels because of those signals, but we would be staying with them until you see something meaningful in the way of a loss of momentum. And that can come in the confirmation of the signal like we have from the S&P 500 as of Friday. It can come in the slope of the 20-day, which you see is still pointing very much higher for gold. what's been good for this space for precious metals, more broadly than gold, is that we've seen a series of breakouts across the space. So gold's breakout's a little bit old news at this point, right? We've seen very good follow through from that, and we can't even arrive at a new upside objective because we don't really have a way to do that. But we've had also breakouts in silver as it stair steps higher. We've had breakouts in platinum and palladium as well. So I think all of that taken together just makes a case for the whole space for diversification and to leverage that upside momentum. So it's good to have a position. It doesn't have to be a big position, but it's certainly gotten bigger for a lot of people in their portfolios.
Yeah. Palo Macro has been doing some great work identifying the sort of as the wave has taken hold, the next metal to fall. Brian asking, and quite a few of you are asking about this, which was my next question as well. So you guys are on it today. What are your thoughts about Bitcoin price relative to gold? Bitcoin typically lagging the gold price action ?
So yeah,
a lot of questions about Bitcoin.
Well, and reasonably so. So we actually publish on Bitcoin on a weekly basis, and we publish that on Monday. So that's coming out shortly. So anybody who's interested is welcome to reach out for that report.
And we have Fairlead's information in the description, folks. You can just
Thank you, Maggie. So the Bitcoin move, it basically was a round trip, which is kind of interesting. You can see it very easily here. This is on the daily chart. So as dramatic as the pullback was, in fact, it was more dramatic than certainly just Friday, right? You see from peak to trough there is about 17%, but it was just a round trip of the surge that preceded it. But it really makes the case, by the way, for waiting for that confirmation for breakouts, because indeed we never saw two consecutive closes that were strong above this resistance area. And therein that breakout to new highs, we did see briefly new highs, wasn't confirmed. And it just prevented us from moving to a bullish short-term bias. We've had a neutral bias on Bitcoin short-term within a bullish long-term context, probably for obvious reasons. But this downdraft just has taken it right back into support. The support that we're watching is about 108,300. And it's simply based on a pretty similar mechanism as we're using for the S&P 500. You can see previous resistance, and it aligns fairly closely with the 200-day moving average. Like the S&P, so let's think about Bitcoin right now as a risk asset. It does have a DeMark sell signal. It has responded to these sell signals in the past as just more potential evidence that we have a corrective phase that's going to keep hold, because it's already been in a corrective phase, unlike the equity market. So we're watching that 108,300 level as support. It's suggesting it's just range bound for now within this broader long-term context. And this is our cloud model, which tends to hold very good relevance, I think, for anything that's commodities or FX, and certainly cryptocurrencies. This was our breakout per the cloud model way back here in 23. So we'd like to see that cloud model rising ahead of price and sort of giving a visual gauge of support. Just like anything, it doesn't act as a magnet, but gives you that nice visual sense that Bitcoin will be moving higher over the coming months. So we're trying to keep our eyes on the long term with Bitcoin. And I think, I would translate that also to Ether and some of the other altcoins, because their long-term setups still look really good and volatility can be expected. But so far, we're not seeing any major breakdowns.
I noticed you said it's still trading like a risk asset. That's how you approach it still. It's worth always asking that question, because with all of the concerns we just laid out fueling gold, there is that argument about it being uncorrelated, but it seems like you still have it in the risk asset basket.
Yeah, I do feel like it's a little bit more closely tied right now to metrics like the NASDAQ 100. We can track that very easily. You see that the correlations there at times are quite high, and then it'll retrace a little bit. So it comes and goes based, I think, on market sentiment. The case to be made for a comparison to gold is really more of a fundamental or macro case. The characteristic of the trend is just not similar right now, but they're both in uptrends. So I'd still treat it a little bit more closely aligned with the NASDAQ 100. It could change though.
Yeah. Yeah. That's why it's always worth asking that question, because if the pattern were to change, it would be significant. Right. So,
Yeah, for sure.
worth keeping an eye on. I want to ask you about treasuries and what you're looking for rates, because this is really tied into one of the pain points. Grant and I spent a lot of time talking about sovereign bonds. What are you seeing for treasuries?
Yeah, so we actually just wrote up TLT as a treasury bond ETF. It's a 20 plus year as a positive setup for CNBC Pro. And we did that because we have a catalyst, right? So when markets start to pull back, it becomes really difficult for us to find a good long idea because of the high correlations on the downside. So that brought us to TLT, and as a way to invest in long-term treasuries. And what I would show everyone, and forgive all the extra lines here that are unnecessary, but this is the ratio of TLT to the S&P 500. And you can see this downtrend. This was the April low in the S&P 500. And a little bit of a shift underway. I think it is notable. It took the ratio above the 50-day moving average pretty decisively. And it feels to me like it could be the start of something that's a bit more meaningful, still counter trend in relative performance, but indeed something that should continue here. Notice also, if we were to look at a weekly version of that ratio, there is one of those DeMark signals. So this is a DeMark counter trend signal supporting a rally in the ratio, which would then support TLT outperformance. The last time we had that signal was right here. So January, again, it doesn't have to be that same dramatic takeaway, but it at least would suggest that it's sort of oversold. And that goes back to that conversation with the oversold sectors. They do tend to do better in this type of environment, and that's part and parcel with what we're seeing there. This is the monthly chart of TLT, and you can see a bit of a triangle formation. Looks a bit like a basing phase. There's an active buy signal here, and the indicators point higher long term. So that would be all conducive to a treasury position. Not until we see a decisive breakdown below 4% by the 10-year, if we do see that, would we expect this to really start to advance out of this triangle, though. So I think it needs that catalyst of that 4% level for the 10-year to be taken out. And it's been really remarkably strong as a support level. The support, we've been watching it for a while now. This is on the weekly 10-year treasury yield. You see this gradual uptrend line. It's basically in line. So being tested right now, it's actually just north of 4% at this point. So if that's taken out, that's where we think things will really start to get moving for the treasury market.
Very interesting. And there are quite a few people who concur with you, Katie, in saying that TLTs started to look less terrible. Some people see it as a good contrarian play, and some people slowly accumulating into global bonds, actively managed. Ched, you're a brave man. Go watch that Grant Williams, then come back to me and put in the comments how you feel. But there are competing things to pay attention to, which is why this makes it so interesting. We haven't with the time we have left, you can tell me, are you looking at uranium? We do have a question about uranium stocks. Are you looking at uranium stocks?
Honestly, I hadn't recently. So why don't we just go ahead and pull it up?
Yeah, Doug asking about that.
That we're always looking for things that have a lower correlation to the S&P 500. And we did find that in uranium at one time, where we felt like maybe there was less actionable, setups in say AI or what have you. And we found that now this is the uranium miners ETF, URNM. So the miners look pretty overstretched, as you can see. They're up against like a DeMark level and look prone, I think, to some consolidation. We also look at the Sprott Uranium Trust, which is SRUUF, and that gives us a sense of the commodity a little bit more closely. And you can see it isn't quite as overstretched in the appearance, right? So it's gotten through the cloud, which we highlighted in our research not too long ago. And so far as held above the cloud. So the cloud shows support to bolster the price of uranium. So I think this is really interesting as a long-term turnaround, having gotten through the cloud. As you know, we use the cloud for commodities. And then another point would be this, which is the ratio against the S&P. So we'd had this phase of underperformance. So if you're looking for maybe a spot of strength, it feels to me like this ratio has turned the corner as well. So just for now, perhaps we can get some relative performance and even some absolute performance from uranium, if not maybe also uranium miners, but the miners are a bit overstretched, obviously influenced by the broader market.
Yeah. That's fascinating. Fascinating stuff. Brian asking, is uranium's move still similar to gold in that it's parabolic, but without many indicators showing a slowdown?
No, I would actually say it looks quite different, at least based on this fund, which represents it. Nothing parabolic here. In fact, it's more of a turnaround. The miners, on the other hand, so if you were to take the uranium miners, so the equities, versus gold miners, you'll definitely see some similarities, like very steep uptrends. But the origins are kind of different of those uptrends. Gold has been very long term, and the gold miners are sort of individually quite different. So similarities on the equity front, but not as much on the commodity front. So perhaps a more direct play for the commodity is the way to go in this environment.
Yeah, great explanation, and important to make that difference, because we sort of talk about them. A lot of people play it through equity, so we sort of talk about it as if it's one, but it's not. You to be really sort of clear which part you're in, and there are complications with that, as we know.
Yeah,
J&J was joking that I like buying bonds is seen as brave now, Maggie. Again, I just came out of that conversation with Grant. You will understand when you listen to it why I said that, but it sort of is, right? If you've been tracking the news in France and the UK, it kind of feels like that. So fantastic chat. Some people shared some really good trades or setups that they are watching, they have on their watch list in the comment section of Substack. Appreciate that. George was one of them, and someone above too, with a cost we're looking at. So some really good ideas. Thank you for sharing them, and for being in the chat today. Some really good questions coming through. Katie, always such a pleasure to catch up with you. I love it so much. Maggie. Thank you so much. Gave us a great framework to work off of as we try to sort of dodge and weave all these noise and headlines. So we appreciate it.
Yeah, good luck with the volatility, everyone. Yeah.
Yes, exactly. Buckle up, I think is what we say, right? So thank you so much. Thanks to everybody who jumped in the chat. Appreciate you. And we will see you again. This is another Wednesday that I am away, but we have the Macro Dirt Pos taking over Dirtcast podcast, Macro Dirt Podcast. I'll get it out right at the end. But they're going to do a takeover talking markets. You're going to have Jared and Tony. So roll up with your questions. Hopefully they're able to read them. We'll see if we can get some help for that. But the events will end soon. So appreciate you hanging with me while I had to step out, but always good intel coming from them. So hope to bring some of that back to you in the chat when we open that up soon. So thanks everybody. And we will see you Wednesday, and I'll see you on Friday. Take care and good luck out there.